I'm going to go over some national numbers on real estate, specifically residential real estate, because on this channel, you guys, that is what we are interested in investing in. The platforms that I've been reviewing, they're all, well, I think pretty much primarily dealing with residential real estate investments that we invest in online. So I wanted to go over the numbers on what's going on nationally with the market. I think some of this information is going to be good news if you're stuck in a property in Arrived Homes. I know in my videos, my review of Arrived, I was pretty harsh on them, on investing with them because their fees are high. And I stated that it's going to be years before you can get out of those properties if you're looking to get out. With some things, well, basically with what's going on in the market right now, just might save you guys if you're stuck in Arrived Homes and give some opportunities for price growth. So let's go over those numbers and I'm going to show it to you. My name is Brian Johnson and I'm a real estate broker, and I've been a real estate broker my whole life. I started in Seattle, then for 20 years I was a broker in Denver, and now I'm back in Eastern Washington. I work in residential real estate brokerage and property management, so I think that leaves me qualified to be talking about these platforms and real estate, residential real estate in general. Now, my biggest concern in the market is it is a concern for a crash, but I don't think we're going to be crashing down. My concern is that we're going to be crashing up. That really is what I think is going to happen, especially in 2024. Now, let's put a little asterisk on that. And that is, we all pay attention to, or if you're paying attention to like real estate news, there's a lot of fear mongering out there, or the crash bros on YouTube, that it's all going to come down to a big, huge crash. Real estate is not going to crash by itself. So if we're watching global debt and the sovereign wealth crisis and all of those things about how the whole economy is just getting wrecked, if that was to happen, if the whole economy crashed, of course, that's what's going to bring real estate down in a really big way. But real estate is not going to crash on its own. So let's just assume that for the purposes of investing right now, that we're going to be looking at sort of the standard economic model of what real estate's going to be doing, absent an overall huge, economic crash. Because if that could happen, if that is going to happen, it could be in 2 months, could be in 2 years, could be in 10 years. Who knows? They're going to be printing a lot of money in 2024 to keep things going. And how long can that keep going? We really don't know. We're definitely in uncharted territory. So let's look at some data nationally on what's going on right now with real estate. Now, this right here is from the National Association of Realtors. It's the median price of existing homes. You can see on the left, it's going back to 2019. Going to the right, we're now in October of 2023. So you can see we've basically just been going up. This is the middle price, the median price of existing homes. In October nationally, we're at $391,000. That's been tracking up now for years. It is not going to be going down right now. It's not going to be going down in 2024. The big reason that we are stuck right now in this sort of increasing home prices, though we hear a lot of bad news, is that it's an inventory problem. We don't have enough houses. We haven't been building enough houses since 2010. And homeowners right now are trapped in their houses if they have a low mortgage rate. And they do. A lot of them, I think it's up to around 70%. I don't have the stat right here, and I can pull it up for one of my next videos, but it's around 70% of all homeowners right now in the US have a mortgage below 4%. Now, if you have a mortgage, just to say you're at 3% and you're at a $500,000 house, and you wanted to make a parallel move to a similar house, you had to move to a different area of your town or to a different town entirely. The problem is to make a parallel move from a $500,000 house to another $500,000 house in a new area, going from a 3% mortgage to a 7.5% mortgage, your payment is going to double at least for a parallel move. That has a lot of people right now trapped in their houses, and they're refusing to sell because of that. Now, we're wondering, how are real estate prices going to go down in the future? Watch two things. The first thing you want to watch is unemployment. Now, if unemployment was to, start going up just a little bit, that's not going to affect the market as much. What you need to see for big housing affordability prices to go down is you need to see unemployment go way, way up into a much bigger number. That is the only thing right now that could cause houses to lower in price. And the reason is because then people are forced to sell because of job losses, and then they aren't buying. If let's say interest rates go down right now in the next 6 months, and let's say they go down a lot to below 6%, and those sellers that are trapped in mortgages can now move and sell their houses. Well, that's gonna maybe for a very short period of time, inventory will go up a little bit, but not for very long because each one of those sellers becomes a home buyer. So they put a house on the market, but then they take one off of it when they go to purchase. So that's not going to increase inventory to drop prices. What you need to see is you need to see a big number of unemployment coming up, and that forces people to sell. And then they don't become homeowners or don't keep being homeowners. Then they do things like moving in with family or they become renters, so that inventory is going to go up. Now, what's the issue with foreclosures? The problem is foreclosures take a long time to work their way through the market. You have judicial foreclosure states and you have non-judicial foreclosure states. In non-judicial foreclosure states, it can happen a lot quicker. But even then, it still takes up to 9 months before those foreclosures really hit the market when people get distressed. It can take up to 9 months to many years. In non-judicial foreclosure states, or in judicial foreclosure states, it's a different process, and it takes a lot longer for those properties to go on the market when they hit foreclosure. Now, also, it's true that if there was a lot of foreclosures that were coming up, they're not all going to hit the market. Let's say there's a neighborhood with 500 houses, and banks have a bunch of foreclosures coming up in that neighborhood, they're not going to put 30% of those houses onto the market. That would crash the price. They will bleed those foreclosures out slowly over time. When this happened in the 2008 real estate crash, which really took about 5 years, I was working in that market, and there were people that stayed in their houses for many, many years while they were in pre-foreclosure. They weren't making payments, and the banks weren't moving on those properties to get them moved. And that was why they didn't want to flood the market with foreclosures, because that drops the price significantly and they lose money. It was a smarter move for them to let people stay there and somewhat maintaining those houses. Many times they weren't, but at least keeping the heat on, and vacant houses break and occupied houses can last longer, and it helps maintain a more stable price. So people are talking about, foreclosures, we're going to be hitting a bunch of foreclosures soon. It's not going to happen. We haven't seen it over the last couple years like people were predicting. It didn't happen. Also, there's been a few other things that people were expecting in the market to happen that would cause a lot of increased inventory, like the Airbnb thing that people talked about. There's too many Airbnbs. I think it was 50% of all Airbnbs went onto the market during the pandemic. Well, those people did not, the Airbnb numbers have gone down some, but those people have not turned into net home sellers. Some people get out of that market. Some of them turn it into long-term rentals. Some of them turn them into a little bit longer short-term rentals, like mid-term rentals, like travel nurse rentals, 3-month rentals for that market. That became a much bigger market, and that's new. That's kind of permanent. That's not changing. So we didn't see a flood of Airbnb inventory either. You need to be watching basically unemployment. So if you want to see if real estate prices are going to go down, watch two things. You want to watch the unemployment number, watch that one. That's a big thing. And then you want to watch inventory. Right now in my market, we have about 2.5 months of inventory in Eastern Washington. I'll get to the inventory number here nationally. I think it's around 3 months or so, a little bit above 3 months. But you need to see inventory above 6 months to start seeing the change in prices. 5 to 6 months of inventory is about what you would expect for a normal, healthy market. So if you see inventory going up to 6 months, you can see we're now into what would be considered historically a healthy market. But you're going to need to see inventory going up beyond that to see a serious effect in pricing. So you want to see inventory going up towards 7 months, then you're going to start seeing that. But the two leading indicators that you want to watch if you want to see about home prices is going to be unemployment and inventory. Now, this graph right here shows the total existing home sales in the U.S. This is just residential homes. This doesn't include condos or large acreage properties. But you can see the volume of sales since 2019. On the left-hand side, we had about 5.4 million houses in 2019. This year, we're projected on the right-hand side in 23 to have about 3.7 million houses sell this year. That's not a lot of houses, you guys. In my market last month, we had 400 houses sell, and we have 2,800 real estate brokers. Who's taking the hit in this market is basically our real estate brokers, because there's fewer sales for us to be competing over. That's happening all over the U.S. We just don't have enough inventory. So we just don't have enough sales. So that's what you've seen when people like in the news are saying the crash in home sales. It's not a crash in prices. It's just a crash in the number of sales, but that because of the inventory problem, it's keeping the prices high. Now, this is another stat from the National Association of Realtors. Looking on the very far right side, it shows you the month supply of inventory going back to 2020 at the top. It was at 3.1 months of inventory during 2020, and going all the way down to October of 2023 down here on the bottom, we're at 3.6 months of inventory. So we're just barely above half of the inventory we need, what you'd be considering a healthy market. That's the problem right there, is the inventory. There's just not enough houses for us to sell. If interest rates come down a lot, yes, that's going to increase the pace of sales, but also we have so many buyers waiting in the wings, waiting to buy properties. There's so many people right now that aren't quite qualified at 7.5%, but they are at 6%. When those interest rate numbers come down, you're going to see a flood of buyers coming into the market. And without enough inventory, you will see that inventory number drop. And we're going to be back into that situation of multiple offers, outbidding each other, people going for no inspections. That sort of number is just off the charts of what happens when people start bidding on properties. You get 20 offers on the property, the price on that house is going way, way up. Now, the list to sale price ratio is going to be different in every market, so it's kind of hard to analyze that. But in my market in Eastern Washington, we're what you consider a pretty relatively healthy market. Our median sale price, though, is above this. Our median sale price is about $410,000 right now for 2023. And our list to sale price ratio has been hovering above 95% for the last 3.5 or 4 years now. Now, the list to sale price ratio, what that means is, let's say a house is listed for $400,000 and it sells for $400,000, then the list to sale price ratio would be 100%. So we're at 95% in my market. And what that means is if you put your house on, you're going to get on average, 95% of your asking price is what's happening across the market, or at least in my market. We've seen that number go as high as 104% during the pandemic. And that is when the bidding wars were happening. That's what I'm worried about happening in 2024. If interest rates go down, the market will go parabolic in pricing. And if you want to see a problem with the wealth gap, what we currently have in this country, you're going to see it get much worse next year if this happens. Right now at about 8%, interest rates are just below 8%, a $900,000 house. Well, if those interest rates went down to 5.5%, that $900,000 house is going to be $1.4 million really quick. That ratio difference, I know a lot of houses are not selling obviously that high, but that ratio difference between 900 and 1.4 million will be the same throughout the entire market. That's how much prices are going to go up if interest rates go down. I know that everyone's worried like interest rates are, they've gone up. They're fighting inflation, and this is important. They need to keep interest rates up because if Powell was to drop rates suddenly in a big way, this market will go parabolic on pricing, and that is not going to be good. I know that we want interest rates, intuitively speaking, we want them to go down, but Powell keeping interest rates where they are, I hope he keeps them where they are for a while now. It does hurt other parts of the market, and I'm not talking about that. That's just, that's a problem with banks and that sort of thing. But I'm specifically talking the real estate market here. So last Monday, JP Morgan released the real estate information that's just like it's not a newsletter. If you go to JP Morgan or just search JP Morgan Real Estate News, you'll probably find this report. And this is talking about what's going to happen next year with home sales. And let's just show you this right here. The Federal Reserve still hasn't beaten down inflation completely. Many market participants now believe interest rates will stay higher for longer. And this is prolonging a set of tougher challenges in the housing market that have almost put into a state of suspended animation. Here's the difficulties, they say. U.S. home prices are currently at all-time highs and less affordable than at the height of the 2006 housing bubble. Sales of existing homes are very depressed, as bad as after the global financial crisis. While buyers wait for sales or prices to fall, sellers won't list their homes because they don't want to sacrifice the low mortgage rates they locked in before the fastest, most aggressive rate hiking in 40 years. Prices aren't, now I'm at the bottom here, prices aren't falling because the market is stuck. Demand has been reduced by high mortgage rates, but supply is even more restricted because of severe underbuilding in the 2010s relative to population growth. Any builders out there will tell you this. They changed the way they find that you can finance new construction. They changed it significantly, and it doesn't help builders at all. So that problem is just getting worse. Plus, in my experience and everyone's experience out there, if you've owned a home or if you've tried to get a hold of tradespeople, it has gotten very, very expensive to hire tradespeople, plumbers, electricians, that sort of group of people. And the reason is because, well, the boomers are retiring. A lot of those tradespeople are boomers. They've left the business starting during the pandemic. They just hung it up and we're done. Plus, they're aging out of the population, and we're not training enough new tradespeople to come into those jobs. That's a problem. That is also a problem that's affecting builders and keeping prices high because they're having to pay people a lot of money. I mean, I know even in my market that we're seeing, if you wanted to be a journeyman plumber at 18 years old, you can get as high as $32 an hour just to start. That's not even as a journeyman, as a trainee. My son was actually going to do this. He went to the union in my town and talked to them about being a plumber, and they would have started him as an 18-year-old training to be a plumber at $32 an hour. That's at 18 with no experience. They were just desperate for people that would show up and that would work outside or work in the rain or work on a Saturday, and they're having a tough time finding people for this. So that affects new construction significantly, in addition to the way that builders have to finance these projects. Now, like I said earlier, that prices are not going to be going down next year, but what can help get houses more affordable? Again, let's go back to the JP Morgan report right here. Rising incomes can restore affordability given enough time. First, here's how we don't think the crisis will be resolved through a crash in home prices. The assumption is that the housing market can only return to a more normal state of affordability and predictable price appreciation after a drop in home prices effectively clears the market and it begins a new cycle. This is certainly not an impossibility, but that would likely require a U.S. recession and a spike in job losses across the economy, neither of which are our best case for the coming years. Nor do we think lower mortgage rates are the solution to clearing the logjam. Indeed, surveys of homebuyers find consistently that financing rates aren't their main motivators when they make a purchase. Life stages are. People buy homes when they get married or when they need to move as they find employment, have children, or retire. This is absolutely true, you guys. This is right. This is it. I talk to buyers all the time in my market. They're still buying at these interest rates as high as 8%. They just need a home. We see another pathway that doesn't involve punishing price declines or a sizable drop in mortgage rates. It hinges on home affordability. Housing affordability could be restored by incomes continuing to rise at a robust rate. We think the path to affordability for starter homes as well as the luxury market is that wages rise to catch up to and meet the higher costs. So here's the big number. When are houses going to be affordable again? How long might it take to restore average levels of affordability based on historic ratios of home prices to income and factoring in mortgage rates? If incomes were to keep growing at their current recent pace, and if mortgage rates didn't decline and home values stayed at all-time highs, their answer, 3.5 years. This tracks with other things I've been seeing from NAR, the National Association of Realtors, and this also tracks what I've been seeing in my local market. Our analysis of the timing is notably sensitive to mortgage rates. If the market's pricing of mortgage rates were to fall by just 1 percentage points, U.S. homes could be affordable again in just 2 years. So, a combination of rising incomes and a 1% reduction in mortgage interest rates, that's what could get and make houses affordable again. That's what we're watching for. So if you're in some of these platforms and you're wondering if you're going to be able to get out, I think prices are going to keep going up for the foreseeable future. Rents also are going to keep going up. And I think that's going to help all of us in our markets. By the way, I have a Groundfloor tutorial coming up. Groundfloor is one of the platforms I've reviewed on here. Where you can invest in fix and flips, where you invest directly with the investor. I'm going to put some money into it, just a little bit, and I'm going to show you a tutorial on how I invest on Groundfloor, and I hope that helps you guys. So stay tuned for that video coming up next.